In market sell-offs like the one we're experiencing right now, the best stocks to buy aren't necessarily the ones that are trending all over the internet. In fact, you're seeing tickers come up repeatedly in YouTube thumbnails or Reddit threads. It could mean you're already late to the party. What you want to do is find stocks with stellar fundamentals and awful price action. It's a simple setup in theory, but a bit hard to pull off in practice. So we found 3 of them, and our Zen Ratings system indicates the market has beaten them down well beyond what the fundamentals justify, and all have the quality to support a real share price recovery. But we also found a popular AI stock that looks like a bargain on the surface, but may be a trap. So all in all, we have 3 snapback plays worth your attention and 1 trap to avoid. I'm not going to spoil which one is the trap till the end, but trust me, you've probably seen this stock all over the place with many folks getting sucked in. By the way, I'm Steve Reitmeister, but everyone calls me Righty. I spent over a decade as editor-in-chief of Zacks.com, and now I'm a partner at WallStreetZen.com, where our quant team runs through every stock through a rigorous 115 fundamental factor review every single day. This helps shine a light on the very best and the very worst stocks. By the end of this video, you'll know exactly which 3 stocks the data says are generally oversold and ready to bounce, and which popular AI name is actually a trap, and how to tell the difference before it costs your portfolio dearly. If this is the kind of research you want more of, then hit that like button now. It tells me to make more videos like this in the future. All right, let's dive straight into our first pick today, which is Box Incorporated with the symbol of BOX. The market's mental model of Box is about 8 years out of date. The story that calcified it in investors' minds goes something like this. Box is a file storage company, and Dropbox is the same thing, but cheaper. You've also got Google Drive and Microsoft bundles these things into Office 365. It was always going to get commoditized, and the stock price reflects that. This narrative is missing the point. That's because Box isn't competing with Dropbox for consumers who want to store vacation photos. Box serve regulated enterprises like healthcare systems, financial institutions, and government contractors, organizations that cannot legally put sensitive documents on generic cloud products. They need granular permissions management, audit trails, compliance certifications across multiple regulatory frameworks, and now AI-driven workflow automation on top of all that. That is a different business solving a different problem for a different customer entirely. And that customer happens to have almost no switching flexibility, which gives Box pricing power and improving profit margin. When you look at Box's execution, you see a clear reflection on these facts. In the past 3 years, they've outperformed earnings estimates in each quarterly report except for one, and that was a modest 1-cent miss. Not something to, cry over spilled milk. Most recently, Q4 came in at 49 cents per share against an estimate of 34 cents. That is an impressive 44% beat. This was also the 3rd straight quarter of accelerating revenue growth, with operating margins now up to 30.6%. Enterprise Advance, which is their premium AI tier, launched less than a year ago and is already accounting for 10% of total revenue. No doubt that will continue to grow. Now, the Zen Ratings system rates Box a strong buy overall. The standout grade is financial strength, where it ranks in the top 1% of all stocks we analyze. The cash flow engine underneath this business is strong and improving. The stock price, unfortunately, does not reflect these improving and impressive fundamentals. The recent softness for all software stocks has helped push Box down about 37% from its highs, trading near the bottom of its 52-week range. The market's mental model on Box hasn't updated, all the while the earnings outlook looks ever brighter. That spells opportunity for the rest of us. This shows up in the price-to-earnings growth ratio of only 0.88%. That is significantly undervalued relative to its growth prospects. Now, Wall Street analysts are starting to wise up to the attractive investment story with Box. That shows up with the average target price pointing to 40% upside from current levels. Even better is the max forecast, implying over 80% upside potential. Now, here again, these are coming from the big name firms like Morgan Stanley, Citigroup, D.A. Davidson, and UBS. Now, before we get to the next pick, I want to plant something in your head. There is a stock in this video whose gross margins have been cut in half in the last 18 months. Not trimmed, cut in half. And it's one of the most recommended buy the dip stocks out there right now. Unfortunately, we think that would be a grave mistake. We'll get there, just keep on watching. Now, as for stock number 2, we have Aveanna Healthcare with a symbol of AVAH. Aveanna Healthcare is the largest provider of pediatric home nursing in the United States, operating across 38 states. The demand for their service continued to expand, and for very good reason. That's because the children they serve have medically complex situations. The alternative is hospitalization that costs 3 to 5 times more per day. Both Medicaid and private insurers alike have a structural incentive to keep these patients at home. Aveanna exists at the intersection of irreplaceable need and cost-effective care, and that's the core of the bullish thesis for the stock. All the while, the market has been pricing shares like it was some run-of-the-mill healthcare provider and not the exciting growth story it truly is. Now, AVAH has a 52-week high around $10.30. Right now, it's about 40% lower. A lot of that pain coming in the past 3 months. It actually went down to under $4 back in July of last year. And listen, the headwinds that caused that drop were legit. $1.5 billion in variable rate debt, reimbursement uncertainty in a labor market that made hiring nurses quite difficult. But how did it turn out in the end? While the stock was selling off, full year 2025 revenue grew by 20% and adjusted EBITDA swelled by 75%. The company expanded its preferred player agreements from 22 to 30 states with a target of 38 states by the end of the year. Those agreements are what allow Aveanna to pay caregivers competitively enough to actually hire them, which feeds directly into capacity, which feeds directly into revenue. The proof of that success shows up in 9 robust earnings beats in a row. Plus, the Family First acquisition, expected to close in Q2 of this year, adds roughly $120 million in revenue that isn't even in the current guidance. Now, Wall Street loves this story where the average fair value target price implies 60% upside in the year ahead. The analyst at Jefferies, who ranks in the top 15% in terms of his actual stock picking performance, has the street high forecast, and this implies an even more robust 90% upside potential for shares. The reason for this upside is a combination of impressive growth and appealing value, like shares trading at a meager 11 times earnings when the average stock is trading for over 20. Not surprisingly, is in the top 5% of all stocks in terms of value according to the Zen Ratings. When the operational progress is this clear, and the analyst consensus is this one-directional, the gap between price and value will close. Not a question of if, but a matter of when. Aveanna is the kind of company that gets overlooked because healthcare services aren't glamorous. But irreplaceable demand, improving operations, and over 60% upside to analyst consensus targets is a combination that's hard to argue with. Before we get to the third pick, if you're finding this research useful, now it's a good time to subscribe and hit the notification bell. We cover stocks the Zen rating system is flagging as data-driven opportunities, and most of these names won't show up on the usual stock lists. You'll want to be here when they do. Now, subscribe now and stick around because a stock with a truly cringeworthy safety score is coming up right after this last bullish pick. That brings us to buy the dip pick number 3 in Docebo with a symbol of DCBO. I'm going to start this one off with a vital number, 0.12. What the heck am I talking about? Well, that's Docebo's PEG ratio. As you likely know, PEG measures price against earnings growth. Anything below 1 is considered undervalued, and thus Docebo's 0.12 is obscenely undervalued. So before we go any further, the question we need to ask ourselves is, what does a profitable, growing enterprise software company have to do to earn a lowly PEG of 0.12? The answer is to lose ground with 2 very large, 2 very visible clients at the same time crushing shares, right? So AWS, right, Amazon's Web Services, decided not to renew his contract with Docebo, and Dayforce has been steadily pulling back its footprint. 2 gusts of headwind in the same year. Revenue growth decelerated, and predictably, the stock sold off hard. Now, it's down more than 40% from its 52-week high. The market pronounced Docebo dead at the scene, but it's always good to get a second opinion on these matters. All that hubbub over those 2 clients overshadowed the fact the business just kept chugging along. As scary as those developments sounded, the damage simply didn't show up in the books. For example, Q4 earnings came in at 45 cents, well above the 35-cent estimate. Gross bookings growth of 12.5% was the strongest quarter since Q4 of 2021, showing that they are finding lots of new customers. And while those high visibility clients were pulling out, Docebo was serving up 16 consecutive earnings beats. A business in structural decline doesn't post numbers like this. 173% earnings growth over the past 3 years. Gross margins above 80%, and they just completed a large share buyback, showing their conviction in what comes next for the company. Now, let's take it from the top. This is a business that builds AI-powered learning management software for enterprises. They do employee training, compliance certification, partner onboarding, and customer education on a global scale. Switching costs are high, which is what leads to pricing power and impressive growth margins above 80%. And yet, the price-to-earnings growth ratio is at a meager 0.12. This is a compelling setup so far. Now, let's go a bit deeper here on the fundamentals. The Zen rating system gives Docebo an A rating overall. That's always a good start to any conversation. The sentiment score also scores an A, meaning institutional investors, the smart money out there, who do deep research on companies are actually moving into these shares. A good example of that is Wall Street analysts as a group expect upside of more than 60% on these shares. Even better is the Street High forecast, pointing to 105% upside in the year ahead. Revenue deceleration is the honest risk here. New enterprise wins need to continue to replace that lost client volume. That's the thing to watch for, and so far so good on that front. But with a rock bottom peg of 0.12 and 80% gross margins and institutional money moving in tells us this is not a broken company, it's simply a mispriced one. The data makes a compelling case that the market got this one wrong, and thus a darn good idea to buy the dip to enjoy healthy outperformance ahead. And by the way, if you want to see more names our system is flagging right now, claim your free copy of our special report, 3 Stocks That Doubled This Year. I'll drop the link in the description below or scan the QR code. Now, let's talk about the stock I've been teasing since the beginning, right? Before I name it, let me give you the framework we use today because it applies to everything you look at in a market like this. A dip is when a fundamentally healthy stock falls because of sentiment, sector rotation, or broader market fear. The business is intact, but the price is wrong. The 3 stocks I already shared all fit that appealing profile. A-rated overall after reviewing 115 fundamental factors with particular strength in revenue and earnings growth is the key to finding hidden gems that have been beaten down beyond what the data justifies. A trap is quite different. A trap is when the stock falls because the business itself is deteriorating. The price isn't wrong. The price is catching up with the bad reality. Weak financials, collapsing margins, souring business outlook. The problem is that these stocks look identical to the dips on the chart. They look very different when looking at the fundamental data. The stock I'm about to show you scores a C overall in our system. That is average at best. The real problem is the safety score of D, where it ranks in the bottom 8% of all the stocks we track. And recently the market got a brand new reason to agree with these weak ratings. The stock that almost everyone on YouTube and social media is hawking, I'm talking about the notorious super microcomputer SMCI. You've probably seen at least some of the content. The stock is down nearly 30% after the U.S. Attorney's Office for the Southern District of New York unsealed an indictment of 3 company associates in connection with alleged conspiracy to commit export control violations. This is not a rumor peddled by short sellers. This is a serious federal indictment. The argument is that it's a temporary sentiment issue and the dip will eventually resolve. The AI server market is enormous and NVIDIA's biggest customers include SMCI. That argument is compelling on the surface, which is precisely what makes it so damn dangerous. It's not the first time that something like this has happened with the company. Last year, it was an auditor resignation. Then a prominent short seller report raised accounting concerns. Then the company nearly got delisted from the NASDAQ. Then an internal accounting review. Now it's a federal indictment of associates for export control violations. At some point, we have to say enough is enough already. Through the lens of the Zen Ratings system, as I said, Supermicro gets a C overall, meaning it is average at best. Yet, here are the serious red marks that it's hiding. Financial strength is in the bottom 35% of all companies. Safety is in the bottom 8%. That's the part I already shared. And momentum is in the bottom 5%. The one component that scores well is growth, which is an A because the revenue trajectory has been extraordinary. Nearly $28 billion in trailing revenue, and 3-year revenue growth of nearly 148%. But go past the revenue line and the picture deteriorates quickly. This is where the gross margins come in, cut roughly in half since 2023 as the company used aggressive pricing to retain customers during the accounting scandal. Return on capital sits at a meager 8.9%, well below the industry average of over 24%, and return on assets at 5.2% is woefully shy of the sector average of 12.2%. The revenue is real. The abysmal quality of that revenue is the problem that makes investment in Supermicro a non-starter. This is the difference between a dip and a trap. When Box or Docebo decline, the fundamentals stay intact and the valuation improves. When Supermicro declines, the fundamentals confirm that it's well-deserved. So there are your 3 dips worth watching: Box, Aveanna Healthcare, and Docebo. And then you have Supermicro, which sure as heck looks like a trap. Quick note before we go: oversold quality stocks can stay oversold longer than you might like, whereas traps can keep drawing in buyers long after the warning signs disappear. Discipline and patience matter as much as the picks themselves. These aren't trades to make impulsively. They're ideas to research, size appropriately, and hold with conviction. Now, I want to hear from you. Of these 4 stocks, which one surprises you the most and why? Drop your thoughts into the comments section below. I read them, and the most interesting ones tend to show up in my future videos. Now, if you want to know how to truly separate the wheat from the chaff, then you need to learn how to read a balance sheet like the pros do. I recently did a video on how the legendary Warren Buffett does it. The video is popping up on your screen right now, so if that interests you, go check it out.